Welcome to Energy Unplugged, the go-to podcast focusing on the global energy transition. My name is Brian Potskowski. I lead the advisory business for the UK and Ireland at Aurora.
And I'm Lizzie Bonahoom, an associate in Aurora's US research team.
It is my pleasure today to welcome Ethan Zindler to the podcast. Ethan is one of the most influential voices on US energy policy, serving as climate counselor for the United States Treasury, where he leads the Treasury Climate Hub and reports directly into the Treasury Secretary, Janet Yellen. Prior to his government position, Ethan was head of Americas for Bloomberg New Energy Finance. Ethan, welcome to today's show.
Hi, Brian. Hi, Lizzie. Thanks for having me.
So, Ethan, what does it actually mean to be climate counselor? How does the Treasury Department fit into U.S. energy and climate policy? I thought that's a good place for us to start, just to set the scene for today's conversation.
Yeah, good questions. Maybe I'll start with the second one. So for those who are, Washington creatures or those who are close followers of U.S. policy, you will know that the Treasury Department plays a really integral role in thinking about energy and climate policy because we are the ones who help write the regulations pertaining to the tax code. And in the United States, the tax code is used to achieve all kinds of different goals. But most notably and most recently, thanks to the Inflation Reduction Act, there are a whole slew of new policies in there intended to promote the growth of lower carbon energy in the US. So we oversee that. We do a lot of other stuff that are related to climate that people may be a little bit less aware about, which is we work directly with the Green Climate Fund and the other multilateral global climate-related funds, including the climate investment funds, to oversee the U.S. investment in those funds. We have representatives of Treasury who sit at the World Bank and the Inter-American Development Bank and the other multilateral development banks, who obviously are very important funders in this space internationally as well. So we do a lot on the international front. We do a lot on the domestic front as well. So that's a bit about Treasury. In terms of my role, the climate counselor is a relatively new job. It was set up at the start of the Biden administration with a real thinking that climate permeates so many of the different things that Treasury does, and so the determination was made that it was really worthwhile to have one person in a small team who worked for me to try to work on all these climate issues as they affect various departments. And to be clear, we have people with climate-related titles in multiple parts of the building as well. But my team's job is really to try to do really kind of four things. One, coordinate the climate efforts across what is a very large department. Second, communicate what we're doing. That's obviously part of what I'm doing here with you today. Third is to collaborate on sort of key policy issues that we think we can be useful on, and often that involves the IRA, but other things as well. And then maybe finally, and most importantly, as my title implies, is to offer counsel to the secretary on sort of key decisions that she makes in the climate space. And just one last thing before I stop, which is that she is a person who really is deeply interested in this subject and has been very committed on climate for really decades now. So as a person so even though I'm the counselor, sometimes I'm the one getting the counsel because she is very, very up on a lot of these topics.
Thank you, Ethan. Let's start with domestic policy. You mentioned the IRA, and it sounds like it's been keeping you all very busy. The IRA has expanded clean energy tax credits beyond clean energy production to include clean energy manufacturing and storage. It's extended the time horizon for credit availability, and it's increased viable ways to monetize tax credits. How would you assess progress made to date?
It's a good question. I mean, I think maybe I'll try and answer it maybe in a couple ways. Maybe there's the work that we've done on Treasury, and then there's what we perceive to be the impact that the IRA has had on the market. And as you note, I mean, just to kind of state the obvious and take two steps back, the IRA is really without question the most substantial law ever put in place in the United States to address climate change, to promote adoption of clean energy technologies, and to make the U.S. more competitive in the production of the equipment that we think is fundamentally going to transform the global economy. So it is a massive, massive commitment, and something I think that we're very proud to be working on. In terms of the specifics, the IRA has no less than 20 clean energy credit provisions that we've been working on. And then, as you also mentioned, it has a number of sort of cross-cutting aspects. There are certain bonuses that you can get for making investments in certain types of communities. And then there's some efforts to make the tax credits, which are really the lifeblood of a lot of this, more flexible and accessible to more people. So we can happy to go into more detail about kind of any of those, but we've been working very, very hard on this. The legislation was passed at the end of July 2022, and it's been kind of a sprint ever since. We've issued 75 pieces of guidance so far. That's over 3,300 pages of regulations, and we've got a lot more coming and a lot of work still to do. But it's been a lot. Just on the sort of second aspect of that question, which is thinking about impact, there's obviously a lot of ways to think about, what the implications have been of the IRA. I guess from my prior days as an industry analyst, I tend to default into counting things like dollars and megawatts. And if you look just purely in terms of dollar flow investment into these technologies, in the United States, we've seen nearly $500 billion invested in the 24 months immediately after the IRA was passed, according to data from MIT and Rhodium. And most importantly, to contextualize that, that's about 71% higher than the prior 2 years overall. So the volume of money moving has been really impressive. I think as an administration, we're also very pleased that we are seeing record volumes of investment in new clean energy manufacturing in the United States, and that's really a new thing that had not been the case in the prior 10 years, really in a substantial way. So anyway, there are a lot of other different sort of great factoids happy to cite, but I'll stop there and say that I think we've been very pleased. But I think we also feel like there's a lot more work to be done on this, and it's not just the rule writing. It's also the socialization and making sure that people are aware of the rules as they exist and the opportunities that these tax credits present. Because they are tax credits, they are contingent on private sector uptake. And so we want to make sure we do get the word out as best we can about this.
And manufacturing has been a big part, but I want to talk specifically about transferability. So transferability made up $4 billion in 2023, around a sixth of the total tax equity market size, which really is a huge increase from zero pre-Inflation Reduction Act. The idea of transferability is to democratize tax credits. And while it's been readily adopted, it's mostly hybrid with traditional tax equity structures. So what is the Treasury doing to further help facilitate this market particularly?
So it's a good question. And just to take two steps back, and again, I know you have a pretty sophisticated audience, but maybe to sort of state the obvious, which is that I would argue that for new zero carbon technologies, the cost of capital is just so critical because in most cases, almost all, if not all, the costs associated with the new wind or solar or other project comes up front. There are not really a ton of marginal costs as you go forward. So whatever the cost of capital that you can get at the time that you build your project really dictates the economics of your project for the next, 10, 20 years, right? So getting the cost of capital down is vitally important. We feel, very good about what we're seeing to date in terms of transferability. And we feel like this has been one of the more successful aspects of the law so far, in a case where we early on set some rules to try and set the marketplace going. And then since then, I think we've been, as you mentioned, Lizzie, that the number of folks who are taking advantage of this has been really impressive. So just to give you a couple facts from IRS data, so far as of mid-September of this year, just last month, we'd seen more than 2,300 individual entities have requested more than 80,000 registration numbers for projects or facilities in all 50 states or territories in the United States. So, a wide variety of credits are being used for transfer. But to be clear, so far, most are related to sort of the kind of good old fashioned ITC, PTC, wind and solar projects, which I think people are most familiar with. But we are starting to see more activity around the manufacturing tax credit at the 45X, among others, as well. So it's been a really strong rate of uptake. There's some great, third-party players out there that are trying to serve as the facilitators of this market and who have some good data as well. That's not, sort of official Treasury data, but they show, as you mentioned, some very good increases. And I think that, you used the word democratize to describe this, and I think there is an aspect of this of bringing a lot more potential players into the investment field here for tax credits, and obviously the greater supply of capital, the more we hope that the cost of capital can decline. Sadly, I've been around this business long enough that I can remember back in 2008 and 9, when the tax equity market basically almost disappeared because of the financial crisis. And so, fairly almost sort of emergency steps were taken to make sure that it could continue to exist. But out of that, there was a lot of thinking about how could we try and get more companies and organizations to make these types of investments. And I think we feel very good that the IRA has done that. And again, going back to my earlier point, though, this is a place where we set the guidelines, and then to some large degree we say, okay, market, go. And so far so good. Obviously, more to be done, and more. The more we provide clarification about the rules that we're writing, I think the more capital we'll see deployed into more kinds of credits going forward.
Thank you for that. Definitely seems like y'all have done so much and still lots more to do. So exciting things ahead. I want to ask now about the cost component of the IRA. In 2022, the Congressional Budget Office estimated the energy and climate component of the IRA to cost $369 billion. However, since then, we've seen this rapid interest in artificial intelligence and a lot of scary headlines with how much electricity these data centers could need if they were to be realized. This has been creating a lot of excitement for US generators. We're seeing that in stock returns with utilities at the best performing sector year to date. Is there a risk that we far exceed the cost of the IRA given higher power demand growth? And how are you thinking about the impact of AI on meeting US clean energy targets?
So a couple of good multiple questions there. I guess the first thing I would just note that forecasting the cost of individual credits is more art than science. And I think we feel pretty good that the overall estimates seem, like reasonable. Will some credits be used more than others? Will the exact numbers be right? That, hard to know. Having once done, attempted to do forecasting for deployment of different technologies, how challenging, sounds like you're in that business, how challenging that can be. It's obviously contingent on a whole host of factors overall. But I think the one thing that we can all agree on is that the era of flat or no electricity growth in the United States seems to be coming to an end. And then the question is sort of just how sharply up does the line go going forward? And I think, that's not entirely clear. There's certainly estimates that, that are all over the board. I saw the other day that the IEA's estimate for the US is that we'll add about 25% more electricity demand through 2035. Interestingly enough, they cite electric vehicles as being by far the biggest driver of that, not AI and server demand. Obviously, on the server side, there's questions about sort of, how much can the efficiency of some of these places be improved? But then even, on a more micro level, the question around AI and server demand seems not only to be about sort of how much new demand places across the system and how much demand it places on individual nodes and individual parts of the grid, given that there can be a tendency towards clustering of these new servers. So there's a lot of open questions on all of these things, and I think what we'll have to just see. But it does seem pretty clear that we're in a world in which electricity demand is going to grow. I'm no longer in the game of trying to predict exactly by how much, but I think it seems like there's some reasonable estimates out there that suggest that it will grow by a certain amount, and it's something that we've sought to take into consideration. And this also kind of takes us out of Treasury's lane just a little bit, and into the larger question about, what can the U.S. do to facilitate more clean energy development? How do we address the bottlenecks that we're seeing around transmission? And there's some legislative efforts to try to address that are underway. But that's, like I said, not directly within our remit at the moment, at least at the Treasury Department.
Well, it sounds like you can use some of our analysis at Aurora to help you formulate your views, Ethan.
Happy to read what you said.
Just before we move on to some of the international topics, there's one topic that we really can't move on from and discuss, given there's a little political event coming up, which is, of course, the U.S. presidential election and congressional elections. So we've seen a variety of commentary coming out from the Republican Party over the past few months around potentially dismantling the IRA. So I just wanted to ask you, how feasible is this from your perspective?
So I guess I'll try to definitely sidestep making any political projections and predictions in my current role. But I'll start by stating the obvious, which is we think this would be a terrible idea. I mean, the IRA has provided the kind of long-term market certainty that the U.S. has wanted for years and years. I've been around the space for a long time. I've seen the many expirations and reinstatements of the investment tax credit and the more often the production tax credit. I've seen, all the different types of unpredictability that investors have had to deal with in this market for a long time. And the really one of the great things about the IRA is so much of it is, on a 10-year plus timeline. And so doing something to disrupt that, we think would be obviously very bad for the market. Now, in terms of sort of, how we feel about this, in general, in terms of its longevity, look, we've done analysis at the Treasury Department that shows that, 85% of IRA dollars have gone to counties with below average college graduation rates. 76% of the dollars have gone to counties with below average median household incomes in the United States. There are others, not us, who have done analyses around sort of, let's just say, the political composition of some of the states where the money is flown. And the other day we saw a letter that was sent by 18 House Republicans to Speaker Johnson, saying that, that they are, supportive of aspects of the IRA. From a purely practical perspective, the volumes of dollars that we're seeing flowing into all kinds of different districts across the country to build out, in particular, manufacturing over the last year and a half has been really impressive. And you have a number of manufacturing plants that, frankly, are due to come online over the next 6 to 12 months. And I just have to think that will play a role in some of the political calculations that get made, going forward. So, we feel like the IRA is making a huge difference. It is helping individual taxpayers save money on what they spend on energy, whether it's by installing solar systems on the roofs or replacing hot water heaters or doing new installation. We've seen about $46 billion in qualifying costs related to both the residential efficiency and the clean energy tax credits for homeowners. We just think that the benefits are being pretty widely felt, and so that makes us feel pretty good about where things are going to go, kind of regardless of the outcome overall.
Ethan, I think it makes a lot of sense that there could be a lot of bipartisan support, and rolling back any tax credit provisions would be met with would not be well received in a lot of states and communities. There's a lot of uncertainty about how a Trump administration could how they will approach this in January, but it seems to be a consensus that a big priority of a Trump administration would be to continue the 2017 Trump tax cuts. That's going to cost $4 to $5 billion in funding, and they're going to have to get that from somewhere. And the IRA and IIJA would probably be attractive places. So, even despite bipartisan support, there's just probably going to be a federal push to find money somewhere. How do you think about this?
Again, I guess I won't try and handicap it, but you are correct that the expiration of those tax cuts is going to. So someone the other day, this was not from me, but I heard someone the other day describe next year as the Super Bowl of tax legislation showdowns, and there are a lot of things to be determined about on a lot of different fronts, So we'll have to see. I mean, the only last thing I'll say on it is just we have an extremely, extremely closely divided Congress in both houses at the moment. And so, we'll see where we end up next year, but it's a good chance that things are going to stay close. And so, it'll just be interesting to see how things play out. It will not be easy. I think we can all agree.
So, Ethan, while we're still on this political topic, I just want to touch on ESG. So this has obviously been a very divisive word in the United States, but the Treasury Department's been pretty active here, publishing its principles for net zero financing and investment over the past year. How has this been received, and what's next?
So, yeah, it's a good question. And, there's just a lot of swirl in this space, in the ESG space, and the last, I'd say 6 to 12 months, I think some of the efforts at the state level with some of the state treasurers, we've seen a few less of those, more recently than we had earlier. But there's other ways to look at it. I mean, the number of shareholder efforts has been declining in terms of sort of the success rates that they've had. So there's a lot going on, and of course you can look at different types of metrics in terms of fund flows. I guess I'm still fundamentally kind of a bottom line kind of guy, in the sense that, like, look, if we had $1.8 trillion globally go into new technologies in the clean energy space last year, according to BloombergNEF, and that's about double what it was about 4 or 5 years ago. That's progress, right? And so we look at actual capital deployed, we look at actual build rates of cleaner energy technologies, you look at what has been happening with U.S. emissions overall. These are all, positive signs. So I think I just try not to get too distracted by some of the noise. In terms of the principles, though, you mentioned, Brian, so last September, we released these principles for net zero financing and investment. And really what they are is just our effort, for lack of a better way to describe it, but to signal to the market what we think, good should look like in the case when financial institutions make net zero promises. And to be clear, they're voluntary because the Treasury Department we don't regulate, we don't directly regulate the banks. That's the Fed and the OCC and others. But what we can do, through the bully pulpit and through the reputation of the secretary, is sort of try and send signals to the market about what best practices should look like in terms of thinking about, like, when you are a financial institution, if you make a big headline promise and you get a lot of attention, what does the follow through on that look like? And so the principles are, they struck me as incredibly sort of common sense. And basically, I won't go through all of them, but basically we said, look, if you're going to make a promise, you should set some metrics that are clear, that people understand. You should be really transparent with everyone, public, everybody, about sort of what those are and how you're achieving them. You should set goals that aren't just in like 2040 or 2050, but are in the short term too. And And then you should be clear about disclosing the progress you've made towards achieving those goals. And so I think the principles have been quite well received, overall, since we've done it a year ago. We continue to have a lot of conversations and dialogue with investors. We hosted an event at Treasury, in July to get feedback, and heard a lot of very, very interesting things. And I think, there's still not always an entirely clear consensus about, what ESG means, I think, if we're really being honest. But I think there's been some really important progress made in this area.
So just on that point, Ethan, there is a gap between US and European financial institutions when it comes to net zero targets and transition plans. Do you see that gap closing at all, given some of your initiatives?
Well, listen, I think different, and we're very clear in what we've said, which is that there is no one size fits all sort of solution to this. And in fact, we do try to emphasize that financial institutions should develop metrics that make sense for them. So I guess I won't cast sort of judgment or aspersion on different organizations in any kind of way, but I think different financial institutions are going to get there in different ways. And of course, the types of financing that you do can often be contingent on where you're located and the types of clients and customers that you have. And so I think that's always something to be taken into consideration as well. A Canadian bank has a different set of customers than a French bank does. So that's often reflected in the types of loans and the work that they do.
Yeah, there's not many UK banks active in funding shale as an example. But just on this topic of finance, I think one area that's really interesting that we've seen some announcements on over recent years is the topic of just energy transition partnerships, or the JETPs. So at COP26, we saw these announcements with a $8.5 billion JETP for South Africa, and then two more announced in 2022, $15.5 billion for Vietnam, $20 billion for Indonesia, and in 2023, 2.5 billion euros for Senegal, with these programs essentially designed to fund the closure of coal plants. So it'd be good just to hear your perspective. How is the US government seeing its role in supporting JETPs? And is this role primarily donor capital, or does it go beyond this?
So first, I guess I'll focus my answer really on the two JETPs where the US has been the primary point of contact, which is the South Africa and Indonesia JETPs. And, we play a variety of roles in this, and have helped these two countries seek to develop investment plans and strategies towards shifting towards a lower carbon economy. And you certainly note that on the one side there's coal, and on the other side though there's renewables, and both countries have the potential for a great deal of further development in those areas. We've worked a lot with the other partner countries, with a coalition of private sector donors, with the multilateral development banks that have been involved as well. But we also provide some technical assistance to these countries to try to help them think about how they can, and particularly South Africa, how they can create hospitable environments for the deployment of private capital overall. I would just say that in both cases of Indonesia and South Africa, who I think are about the 10th and 15th biggest CO2 emitters in the world, these are countries where coal is very much ingrained in the economies, and not just coal consumption, coal production too. They were countries which I think we and this is before I actually joined Treasury, but I think they were selected in part because of the potential impact that could be made by helping them make a transition. But there are also countries where not everybody has complete access to energy. And so that's something to be kept in mind as well. 10%, I think, of households in South Africa lack access. And then there's a number more households who have access, but it's not terrific because the grid's not perfect by any means. So there's a lot of different kind of goals attempting to be achieved simultaneously. I think we feel like we've made good progress, but these were not going to be easy places to sort of just get quick wins on by any means. And I think we've made really important but progress, but it's going to take some time.
Yeah, and if you look at a country like South Africa, where the unemployment rate is so high as well, it compounds that challenge. How do you shift an entire industry without adding to unemployment and doing so in a way that transitions these workers and doesn't exacerbate unemployment? It absolutely incredibly challenging.
Yeah, no, it's a very good point. And I think, critical part of this has to be not just about saying, okay, we want to close existing this, that, or the other, but what are we going to build? What are the opportunities that are going to be created by adding these new technologies? And so we've seen some good investment. We certainly like to see more.
So as you know, Ethan, the progress has been a bit slower than maybe some people would have anticipated. So, what have those barriers been? Or is it a case that expectations maybe were too high coming out of COP for these mechanisms, and people had unrealistic expectations for the timing of transitioning these assets? And how do you think we can overcome those barriers to actually start to see capital flowing and coal assets closing and being replaced with other, say, cleaner energy sources?
It's a good question. So, I mean, first, like I said, coal is a fundamental part of these countries' economy. And they understandably and justifiably want to achieve higher rates of development, and their political leadership want to make sure that they are, providing the kind of opportunities for their country that and their populations that they deserve. So that's a kind of fundamental challenge. And then in addition, in the case of South Africa, maybe in particular, there are longstanding issues around the reliability of the grid, and around some of the situation with the state-run utility that really go back, really decades. And so we've sought again to provide technical assistance to try and work locally, and also to try and mobilize the capital that's required to be invested. But it's a kind of there's two parts of this. The conditions have to be sufficiently safe. I don't think that's or sufficiently comfortable, I should put it, for private investors to want to deploy capital. And so, trying to do sort of both things at the same time, make sure that there's, private money that's ready to go, and making sure that the conditions, are sufficiently hospitable again for capital deployment it's not an easy task, and it's not something that's going to happen overnight.
Definitely an area for us to watch, and will be interesting to see what comes out of COP29 in a few weeks. But I think that's a good place for us to pause, Ethan. And just before we wrap, we do have a little tradition on the podcast where we ask each guest whether a handful of topics are either overrated or underrated, and then to say us in a sentence or two why that's the case.
All right, to start us off, Ethan, pronunciation of the IRA is IRA, under or overrated?
Appropriately rated. I like that. I've heard it referred to as Uncle Ira, and I think I even heard someone call it Uncle Bill, which is the bipartisan infrastructure law as well.
Cute.
So the second topic is a nuclear renaissance. So we've seen a number of announcements over the past months, number of tech giants announcing various deals in the space, Microsoft and Constellation potentially restarting 3 Mile Island, and Amazon just the other week investing in small modular reactors. So is the concept of a nuclear renaissance under or overrated?
Well, A, it's extremely intriguing. B, I would say that I'm much more bullish on the reopening of existing reactors, or than I am about promises to buy power from projects that are due to be online in 2030 and beyond.
We know a thing or two about that in the UK as well. The next topic is COPs. So we have COP29 just coming up around the corner in Azerbaijan. Are COPs under or overrated as a mechanism to address climate change?
I mean, I work in government. They are absolutely appropriately rated. Look, I think they play a very important role in bringing everybody together and having very important conversations about what we're all going to collectively try to do. And just as a forcing mechanism to get everybody together and talk about what they're achieving, I think that is very, very valuable in and of itself. And then there are other broader goals as well that I think are also important. But even if that's all you care about, even if it's just about getting together and talking, that's really valuable.
Excellent. So, Ethan, last but not least, I know you're a big Red Sox fan. Under or overrated the Red Sox winning the World Series in the next few years?
Totally overrated. I can't keep up with the spending and the lineup of the Yankees these days. It's ridiculous.
You've lost your hope.
It's not been a great run for us. Let's put it that way. We did a little better this year than we had the last couple.
Well, that I think is a good place for us to wrap. So, Ethan, it's been really fascinating to hear all about the work that you're doing at Treasury. And just want to say a very big thank you for your time and coming onto the podcast.
My pleasure. Thanks, guys, for having me.
Thanks, Ethan.
That was Ethan Zindler, Climate Counselor for the United States Treasury, talking to Brian Potskowski, who leads the advisory business for UK and Ireland at Aurora, and Lizzie Bonahoom, Associate in Aurora's US research team. Thanks for listening to Energy Unplugged. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to follow or subscribe to the podcast via whatever platform you use.